Forex chart patterns repeat because market psychology repeats. In this video, we'll break down the most important chart patterns in Forex trading, using real market examples so you can learn how professionals read the price. A chart pattern is a visual structure formed by price movement over time. These patterns help traders identify trend continuation, reversals, and breakouts. Understanding them gives you a framework for making decisions instead of just guessing. First up, the ascending triangle. Here on the chart, you can see price making higher lows while facing the same resistance level. This tells us that buyers are getting stronger and are consistently pushing the price up against that ceiling. In Forex, this pattern often breaks upward, signaling a potential bullish continuation. It's all about that building pressure. On the flip side, we have the descending triangle. This pattern shows sellers gaining control. Price keeps testing a flat support level, but each bounce is weaker, creating lower highs. This suggests that selling pressure is increasing. A breakdown below that support level often leads to strong bearish moves as the floor gives way. Now, let's look at the symmetrical triangle. This pattern represents consolidation or a market taking a breather. The price action gets tighter and tighter as the trend lines converge. Volatility is decreasing, and the market is essentially compressing like a spring. Traders usually wait for a confirmed breakout from either side to determine the next move, as the direction depends on which side wins the battle. This next one is a classic, the head and shoulders pattern. It's one of the most reliable reversal signals in Forex. After an uptrend, you'll see a peak, a higher peak, and then a lower peak, forming the left shoulder, head, and right shoulder. Once the price breaks below the neckline, which connects the lows, it often confirms that the uptrend is over and a new downtrend is beginning. And of course, there's its opposite, the inverse head and shoulders. This pattern signals that buyers are stepping in after a downtrend. You'll see a trough, a lower trough, and then a higher trough. A breakout above the neckline is a strong sign that the downtrend has lost its steam and a new bullish trend could be starting. Here's a simpler reversal pattern. The double top. It forms when price hits a resistance level, pulls back, and then fails to break that same resistance level a second time. This M shape suggests that buyers have lost momentum. Once the price breaks the support level in between the two peaks, sellers usually take firm control. And its counterpart, the double bottom. This W-shaped pattern shows strong buying interest at a specific support level. Price hits a low, bounces, and then successfully holds that same low a second time. A break above the resistance level in between confirms a bullish reversal, showing that buyers have defended the level and are ready to push prices higher. Finally, we have flags and pennants. These are fast continuation patterns that form after a strong, impulsive move. The market takes a brief pause, consolidating in a small channel or triangle. This pause is usually just the market catching its breath before continuing with high momentum in the same direction. So, how do you trade these? The key is to always wait for confirmation. Don't jump in just because a pattern looks like it's forming. Enter on a confirmed breakout. Place your stop loss logically beyond the pattern's structure to protect yourself, and set your take profit target at the next key level or based on the pattern's size. Of course, not every pattern will play out perfectly. Common mistakes include trading without confirmation, fighting the overall market trend, or using too much leverage. Remember, these patterns are about probabilities, not certainties. Chart patterns don't predict the future, but they do provide a roadmap. They help you understand market psychology and react to price action with logic and discipline. Practice identifying them, and you'll add a powerful tool to your trading arsenal. Thanks for watching. If you found this helpful, be sure to like the video and subscribe for more trading insights. See you in the next one.